All right, so trade talks going on right now. Surprised that another day we're seeing the futures just a bit muted. Not a lot of action in the futures, even though these trade talks are actively happening.
It's critical. The most critical outcome that I see coming out of this week is some formal agreement as it relates to rare earth minerals. Those rare earth minerals are desperately needed by auto manufacturers and defense contractors. And China right now either produces or processes 90% of the world's rare earth minerals.
All right, so speaking of defense, that's your word of the day.
Yes.
Are you saying investors should play defense? I mean, we were talking about this earlier. The S&P's back above 6,000, kind of a key sentiment level. Huge run up from those April lows, more than 20% run up from there. So is now the time just to kind of batten down the hatches and play some defense as an investor?
Yeah, in this case, I'm talking about defense, not defense. And from the standpoint of follow the money, national defense. Last year, we saw nearly a 10% increase in defense spending across the globe to $2.7 trillion, the largest annual increase since the Cold War. Europe increased by 17%. Germany increased by 28%. We understand the Trump administration has proposed an over $1 trillion defense spending budget this year. So if you're looking to follow the money, become more offensive by investing in defense.
All right, that takes us to your pick, which is RTX. Now, why RTX out of all the different defense companies?
Sure. So RTX operates out of three segments: Collins Aerospace, Pratt & Whitney, and of course Raytheon. Raytheon is the most attractive from an investment standpoint. They produce and distribute air and missile defense systems. Think the Iron Dome. Stock's up over 21% year to date, has a trailing 12-month dividend yield of nearly 2%, and the forward PE is just around a little under 23, roughly in line with the market. I think a lot of that defense spending is going to go to big defense contractors such as RTX.
Your pick is RTX. Looking at the charts right here, since the tariffs were put into place, RTX shares up just about 6%. I want to go back to the other. I don't even know how to the inflection defense when we're talking about trading. Let's go back to that one. I was mentioning to you during the break, I was talking to somebody who works a lot of pension funds. He says pensions are putting a lot of money in bonds right now because stocks are less attractive. Stocks are kind of at the 90 to 95 percentile of every metric, whether it's valuation, et cetera, and that bonds are more attractive. So for investors, is it time to be more defensive and maybe put money into bonds? And if so, corporate, treasuries, short end, long end?
Sure. I think it depends upon what your objectives are and what your risk tolerance is. If your objective is income and you're more conservative in general, bonds are always an appropriate solution. Think about municipal bonds for investors in high tax brackets right now. The tax equivalent yields of many investment-grade municipal bonds are very, very attractive and worth consideration. And we also see the outlook for yields perhaps factoring into the need to add bonds to your portfolio from a diversification standpoint. So yes, I think stay investment-grade quality. Look to munis if you're a high tax-free bracket.
Other side of the coin, very quickly. Is there opportunity risk of the idea that the trade deal happens, equities take off again? If you're in bonds, then you don't have the opportunity to take advantage of that rally. Are you looking at that risk as well?
Yeah, I think there's more of a risk to the downside than there is to an upside. But if we get a formal agreement as it relates to the rare earth minerals and we ease up on some of our chip restrictions with exports, I think that's a tailwind for the markets, at least over the short term.